Hello, my name is Masa Takeda, the portfolio manager of SPARX Japan Focus All-Cap Strategy. I hope everyone is having a wonderful summer. If I had to summarize the first half of 2026 in just a few words, I would say AI, 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 and the growing conflict between the United States and Iran. Those two themes dominated headlines and often drove markets on what felt like a daily, if not hourly basis. In that environment, it was easy for investors to focus almost exclusively on developments in the AI universe or the Middle East. Meanwhile, some important developments in Japan received far less attention. Japanese equities continue to reach new historical highs, corporate reforms continue to bear fruit, and global investors such as Berkshire Hathaway further deepen their relationships with leading Japanese companies. While much of the world's attention was elsewhere, some of the most interesting investment opportunities continue to emerge in Japan. And that leads to the main point I'd like to make today. The Japanese market remains strong, but market leadership became increasingly concentrated. A relatively small group of companies associated with artificial intelligence, semiconductors, and technology-related capital expenditure accounted for a large share of market performance. At the same time, many other businesses continue to improve operationally and financially while receiving far less investor attention. For an active investor, that is often where opportunities emerge. My investment approach has not changed. For those who may be newer to the strategy, the foundation of my process is quite simple. I look for high-quality businesses with strong management teams, durable competitive advantages, and attractive valuations. Rather than trying to predict short-term market movements, I focus on situations where market price and intrinsic value have diverged, and where that gap can close over time. In this update, I'd like to discuss several areas that I believe are particularly important in understanding both the Japanese market and my portfolio today. Let me start with artificial intelligence, because it has clearly been one of the biggest drivers of market sentiment this year. Across global equity markets, enormous amounts of capital have flowed toward companies expected to benefit from AI adoption. Japan has participated in that trend through semiconductor-related companies, electronic component manufacturers, and businesses involved in advanced manufacturing. There's no question that AI has the potential to create significant value over time. However, from an investment perspective, I think the more interesting question is where long-term value will ultimately be created, and whether current valuations already reflect that future potential. Within the portfolio, companies such as Tokyo Electron continue to benefit from investment in semiconductor capacity and AI infrastructure. SoftBank Group is another company that naturally attracts a great deal of investor attention. Investors continue to focus heavily on the near-term outlook for SoftBank, given its involvement with ARM and OpenAI. My focus remains on long-term value creation. If AI platforms continue to differentiate themselves and enterprise adoption continues to expand, the long-term value embedded within these assets, ARM and OpenAI, may ultimately prove greater than many investors currently assume. Having said that, one point I would emphasize is that the Japanese market is much broader than AI. Many investors have become concentrated in a relatively small part of the market. As a result, a number of businesses with improving fundamentals have received considerably less attention than they deserve. And that brings me to the next point. While AI has captured much of the market's attention, I continue to believe that one of the most important developments taking place in Japan is the ongoing improvement in corporate governance and capital allocation. This is something I have discussed for several years, and I continue to believe it remains one of the most important long-term drivers of Japanese equity returns. What encourages me the most is that these changes are no longer just discussed in investor presentations. They are increasingly visible in management behavior. Companies are becoming more disciplined in how they allocate capital. Management teams are focusing more closely on profitability and return on equity. Balance sheets are being managed more efficiently. And shareholder returns are becoming a more important part of corporate decision-making. At the same time, Japan continues to move away from the deflationary environment that defined much of the past few decades. Moderate inflation, improving wage growth, and a more normal interest rate environment are encouraging companies to think differently about capital efficiency and value creation. I do not see these changes as temporary. Even after the market's strong performance, Japanese equities continue to compare favorably with many global markets from a valuation perspective. When I combine that with improvements I continue to see in corporate behavior, I remain constructive on the long-term outlook. The benefits of these changes can be seen clearly in some of my highest conviction investments. Tokio Marine is a good example. Many investors will be aware that Berkshire Hathaway recently entered into a strategic partnership with Tokio Marine, a development that naturally attracted considerable attention among global investors. While that partnership is certainly noteworthy, it is not the reason I find the company attractive. In fact, we first invested in Tokio Marine several years before that partnership was announced. What attracted us then is essentially the same thing that attracts us today. It is the quality of the company's management and its ability to allocate capital effectively over long periods of time. The insurance business generates a large and recurring pool of capital, but what ultimately matters is how that capital is deployed. In Tokio Marine's case, management has consistently demonstrated discipline in underwriting, thoughtful capital allocation, and a clear focus on long-term value creation. The company has built a business capable of generating attractive recurring cash flows and then reinvesting those flows at attractive rates of return. Over time, that can create a very powerful compounding effect for shareholders. For that reason, I continue to view Tokio Marine very positively. SPARX is another company where I continue to see meaningful long-term potential. In my view, many investors still think about SPARX as the company it used to be, rather than the company it's becoming. Management has steadily reshaped the business toward areas that require less capital and generate more stable, higher quality earnings. The sale of SPARX Bank is one recent example of management's willingness to improve long-term shareholder value rather than simply preserve the status quo. At the same time, I believe the market continues to underestimate the value embedded within SPARX's investment portfolio, asset management business, and broader corporate transformation. What I find particularly attractive about both Tokio Marine and SPARX is that they combine strong underlying businesses with management teams that are increasingly focused on creating shareholder value. That combination is one of the qualities I consistently look for when evaluating long-term investments. Another company I continue to find interesting is Seven & i. What attracts me here is the opportunity for corporate change and value realization. Investor sentiment toward the company has fluctuated considerably over the past few years, and much of the discussion has focused on short-term developments. When I step back, however, I continue to see a business that owns valuable assets, generates substantial cash flow, and possesses meaningful opportunities to unlock shareholder value over time. Importantly, the company operates in an environment where expectations remain relatively modest, while the potential for strategic and operational improvement remains significant. As we have seen repeatedly in Japan in recent years, when a company improves capital allocation, sharpens its strategic focus, and becomes more responsive to shareholders, the market can reassess its value quite quickly. I believe Seven & i remains an interesting example of that broader opportunity set. The final area I would like to discuss is Japanese homebuilders with significant exposure to the United States. This includes companies such as Sekisui House, Sumitomo Forestry, and Daiwa House. Admittedly, these investments have not contributed to the portfolio's outperformance over the past year. The US housing market has remained weaker for longer than many expected. However, my overall view remains largely unchanged. The United States continues to face a structural housing shortage, and I believe Japanese homebuilders possess durable competitive advantages built through scale, operational expertise, and years of investment in the market. Importantly, these companies are no longer niche participants in the US housing market. Through acquisitions and continued investment, they have built meaningful positions and strengthened their competitive advantages. For me, this is not simply a cyclical call on housing demand. It is a long-term investment in companies that I believe can continue gaining market share and creating value over time. That is why I continue to find the opportunity compelling despite the near-term challenges. To conclude, the first half of 2026 reinforced a lesson that has shaped my investment approach for many years. I have often found that some of the most attractive opportunities emerge when investors become heavily focused on a relatively small part of the market. Today, investors are understandably focused on AI. AI will remain an important driver of markets, and some of the companies benefiting from it may continue to create tremendous value. But when I look across Japan, I continue to find attractive opportunities far beyond that narrow part of the market. Whether it is improving corporate governance, disciplined capital allocation, corporate transformation stories, or long-term structural themes, I continue to find businesses whose intrinsic value may not yet be fully reflected in market valuations. That is where I continue to spend most of my time, and it remains the foundation of my investment process. Thank you very much for watching. I appreciate your continued interest in the strategy, and I look forward to speaking with you again in our next update.